If you're a Canadian DIY investor, this video is for you. Emerge is a Canadian fund company that licensed ARC Innovation's portfolio strategies and made them available to Canadians here as a Canadian listed ETF. Canadian retail investors jumped on the opportunity to get on the Cathie Wood bandwagon, but ended up getting burned once losses started to pile up. Once the news came out that Emerge's auditor had resigned and had not yet been replaced, this started a domino effect at Emerge. Emerge missed the deadline to file their financial statements with the OSC. The Ontario Securities Commission then issued a cease trade order, and then it became clear that Emerge had a $2.5 million receivables that they owe to their ETFs. And finally, the Emerge ARC Innovation ETFs were all delisted from the Toronto Stock Exchange. Investors recovered what little value was left, and the rest became unsecured creditors to Emerge. Emerge is currently under investigation, so we don't know exactly what caused this whole fiasco, but investors have expressed doubts in smaller fund companies and ETFs as a whole. But what are the real lessons here? From an investment executive article, we learned from a DIY investor that piled in $155,000 from their RSPs into these Emerge ETFs, and were only able to recover a fraction, that is less than 40%. That is not just a risky move, that is extremely foolish. The investor said he won't be destitute, but if anything, he probably has to push his retirement 1 or 2 years further and may have to look into moving to a lower cost region to live out his retirement. If he were properly diversified and followed sound financial advice from a professional, he'd probably never had experienced this level of loss. Yes, many brokers and advisors can suffer from the madness of the crowds, but we do have to keep in mind the interest of our client. We have to ensure that their investment choices or our investment recommendations will not endanger the objectives of the portfolio. And we have the responsibility to document our conversations, recommendations, and trades between the advisor and the client. This case highlights many of the problems with DIY investors. Yes, by doing it yourself, you can save money that you would have otherwise paid to an advisor. But DIYers forget why they're investing in the first place. It's to achieve financial security. You can take a big bet and win and brag about it to your friends. Or you can also lose big and you won't be telling your friends about it at the next barbecue. Winning or losing can result in the wrong lessons learned and reinforce bad behaviors like market timing and excessive trading. These can add up and reduce your long-term financial security. Another problem is Cathie Wood's thesis by investing in technological revolutions. Much smarter people have written about investing in technological revolutions, but you can check out a video from Ben Felix that is pretty good on the subject, and I hope you can learn from it. All right, with that, I'm going to let you go. Stay invested, stay classy.